Hi everyone. Today we'll be going through a case study of Aarti Industries, mainly focused on its valuations. Let me share screen with you guys. So Aarti Industries is one of the poster boys of the specialty chemical and China plus one strategies in India. They are a very large, considerably large manufacturers of specialty chemicals and pharmaceutical ingredients. So uh, many of my investors and friends have asked me that is it the right time to invest in the stocks of Aarti Industries? And their main interest lies from the fact that if we look into year to date, Aarti Industries has declined by 20%. On the other hand, the benchmark or the broader market has has been almost flat. The the mid and small caps have generally corrected by 10 to 15%. So before moving on to the crux of our presentation, let me give a brief overview about the business for for a better understanding of the company. So this is a specialty chemical company which mainly manufactures the benzene derivatives. They are mainly focused on products which are import substituents, which were earlier manufactured outside the country and imported and then subsequently consumed. They have also been a big beneficiary of China plus one theme, with revenues and profitability growing at more than 20% for, for a considerable period of time, 6, 7 years. Now, majority of the business consists of specialty chemicals. Some part of it consists of pharma business. Large part of the customers are domestic. Some of, on the other hand, around 40% is exported to other other countries. Coming on to financials, we find that the revenues have grown more or less at around 19-20%, with both for pharmaceutical and specialty chemicals growing at almost similar rate of around 19-20%. Now, so there has been a key development last year in the October to December period where there was a customer with whom Aarti Industries had uh, co-invested in manufacturing plants and they were their customers, long-term customers. But that customer wanted to cancel their contract. So there was a termination cost which they had to pay to Aarti Industry for canceling those contracts, due to which Aarti Industry received around approx 600 crore rupees in Q3 FY22. Now, this 600 crore rupees being an exceptional item and comes directly into the other income of the accounting standards and does get added to the bottom line directly. Now, what has happened is due to which, if we see look into the profit before tax, had it not been for the termination cost, the profit before tax would have been 247 crore. While because of the termination cost being added, it it has moved to 858 crore rupees, approximate 611 crore rupees increase. Now, due to this, the base of the last year's base of profitability has increased. So if we simply do, although there are multiple valuation techniques, price to book, price to sales, price to earning, obviously free cash flow, DCF analysis is also done. Price to earning ratio, although being a very, um, it's not one of the perfect valuation methodologies, but it does indicate a lot of things. So if we take price to earning ratio, and most of the means relatively new investors or novice investors particularly focus on this ratio. So what we saw in the valuation earlier as well, that the price to earning ratio of Aarti Industries was being traded at 22 times, which is considered generally low for high growing companies with good financial metrics. But over here, if we draw the bar graph of the price to earning ratio, we find out that it is 22 times price to earning ratio. But if we exclude the exceptional item, then price to earning ratio moves from 22 times to 40 times. This is a considerable jump. So, whether it is justified or not, that would completely depend on the future uh, outcomes of the business. What is the growth rate of the business? Because the stock price movements are generally aligned with the growth rates of the profitability of business. So, according to the management guidance, obviously management has the most better understanding of their own business, and they are, according to them, they have given a they according to their own visibility, they have given us basic guidance in which they feel that from in FY27, the turnover, which is sales, will be 2.5 to 3 times that of FY21. Basically, from 5,000 crore rupees to it will move to around, let's say, 12,500 crore, or let's say 17,500 crore approx. And the profitability will also similarly move by 3 to 4 times. So what I did now, one thing has to be understood, that all these revenues are coming out of the capex which they are doing, additional capex which they are doing, and and so what I did in order to make an estimate, I thought of making a reverse calculation. Although reverse calculations can be done in many better ways, but for easier understanding, we have just taken simple metrics of sales pat, not gone into the reverse DCF and all, because that's relatively complicated. Now, I have taken over here the FY21 sales and the two scenarios of FY27. The first one being of 3.5x, of 2.5x, the other being of 3.5x. So multiplied by 2.5 and multiplied by 3.5, got 11,265 crore and 15,771 crore. Similarly, PAT I have multiplied by 3 times or 4 times. Now, over here in FY22, because of extra 600 crore rupees, there has been considerable jump. Now, from FY22 to FY27, if we calculation, simply do a calculation of profitability growth, the compounded annual growth rate comes out to be 4% in the lower growth rate scenario. And on the higher growth rate scenario, it comes out to be 8%. Now, if in FY27, given the fact that Aarti Industries will be a much more larger company with much more larger base and a relatively stable set of products, and given that will not be growing at such high rates, even if we assume a multiple, I have considered a multiple of 25 times in the lower profitability case, and for the higher profitability case, we have taken 30 times in order to take the both sides of the spectrum, come to cover up the complete range. What we find out is the market cap at FY27 would be in somewhere in the range of 39,225 to 62,760 crore rupees. Now, the present market cap of FY22 is around 29,332 crores. If we do a reverse calculation, we get a compounded annual growth rate of 6% in lower profitability growth case, and 13% in higher profitability growth rate case. Now, in the past, Aarti Industries profitability has been growing at a compounded annual growth rate of more than 20%. And so did the share price, which basically generally trails the profitability. But from here, at this moment of time, it seems that the profitability will not be growing at such higher rates. So does this business command such high valuations? That is what you have to be asking yourself. Obviously, it's a probability based event where the growth rate of the business can be much more. They might have much larger sales at FY27, but we made a guesstimate at this moment, and we are simply trying to make an estimated guess, educated guess, to ascertain what scenarios can evolve for this company. So from this point of time, the growth rate doesn't seems to be growing at such high rates. Given that for FY23 as well, the management has guided up till this point of time, the bottom line to be growing in the single digits, growth rate of single digits. So that's why the stock prices have calculated. Generally, what retail investors make a mistake in multiple companies is that they consider just because something has fallen doesn't 50% doesn't mean it cannot fall another 50%. It can fall 100% from. I'm not saying that this company will do that. It's a much better company with much. It's a very good corporate governance and very good fast track record. But share prices are volatile and they can take their own stance. So I hope this calculation and all these explanations have been of use to you. I thank you. Thank you all for patiently watching all of it.